Hello, good evening. My name is Amy Jurek and I'm with Remax. It is the end of March and there has been a much anticipated Federal Reserve meeting. Realtors, brokers, loan officers, construction workers, everyone in the real estate field has been anxiously awaiting kind of what the thoughts are on the Fed and the current state of our economy. So Brian and I are going to be joining tonight to discuss what had all came down today in the news from the Federal Reserve meeting. Hey Brian, how are you?
Hey, I'm doing good, Amy. How are you doing?
Good. You look like you're maybe at the Federal Reserve today. That's quite a
Very sterile. I'm in my corporate office today in a temporary office, so I'm not looking as flashy as you are today.
I love it. I love it. Well, that's great. It's still great that we could get together. So,
Yeah.
a lot of news, a lot of things shook down in the last day or two, and we haven't even spoke. So, I appreciate the impromptu meeting. How did what was the outcome today?
So they raised rates 25 basis points. They tapered off, and they're also starting to use some caution in terms of where they want to go from here. And a lot of this comes from this small banking crisis that we've had over the past 10 days. The Federal Reserve and the Treasury, they've come in and they've shored up the banking system. They just moved at 25 basis points. Again, the pursuit of the Fed is to slow down the economy so they can bring inflation down. Inflation is why rates are so high. Everyone suffers from it. We've all experienced it every day with the cost of rising fuel, with food, and the Feds are being really aggressive.
Okay. Interesting. Wow. So when you say interest rates, are we talking about interest rates on credit cards and car loans, or are we talking about mortgage interest rates, or all?
Great question. One of the most confused topics that there is. When the consumer hears that the Feds are raising rates, I've even seen it on TV where news journalists are saying, well, they just raised rates and getting a mortgage is going to be harder. They are raising short-term rates on credit cards, car loans, consumer loans, and the federal funds rate that banks borrow to each other, which is now 5%. It is not related to mortgage rates. They are raising these short-term rates. Basically, Amy, do you know that the average interest rate on a credit card right now is 20%?
Oh my God.
20%. So I read an article last night. If a consumer had $5,000 on their credit report, just the amount of additional interest that they would pay and the length of time that would take to pay it off, because those short-term consumer credit costs have gone up so much. Now, what happens is by doing that, the consumer is going to stop spending, hopefully. And when the spending comes down, see, what happened was trillions of dollars went into the economy. There was too much money chasing too few products. And so all of those retailers and wholesalers were able to raise their prices, and inflation took off. So what the Feds are trying to do is discourage us from spending money, so then the prices can come down. When the inflation comes down, mortgage rates will come down as well. So mortgage rates are absolutely tied to inflation. When inflation's high, mortgage rates will be high.
That makes sense. Okay. So, and this happened to me last time the Fed raised interest rates, right? And it goes across the news wire. I was out literally with a buyer and she kind of looked at her phone because I think she got a Google alert or Apple alert or something. And she goes, "Oh my gosh, interest rates went up. Shoot, this will probably cost me a bit more than what I thought." And I'm like, "No, it's separate. This is different. This is for credit cards and car loans and things like that, which, by the way, you shouldn't be buying any cars or putting a lot of debt on your credit card when you're buying a home anyway."
No.
Right.
Well, what's interesting, Amy, is consumer credit debt has risen a lot since we've hit this inflation crisis, because a lot of consumers don't want to change their lifestyle. And so, charging things has continued to elevate, and we have very high credit debt in the nation right now. hopefully we can get things turned. Now, I did share a graph for you
Yeah.
because really a key part of inflation right now is shelter,
Okay.
such as rents. But as you and I know, rents are
Mm-hmm.
typically on a 12 to 18 month duration. You get a new lease on an apartment and you sign a lease for 12 months. So this
Yeah.
is a lagging index. Do you know that shelter or the cost of rent is 43% of our core inflation? So
Wow.
what's happening is if you look at that chart, you can see how high it was previously, but it's been
Mm-hmm.
steadily coming down. And the magic date, at least what my experts are telling me, is that by May 10th, this lagging index of rents is going to kick into the inflation number and should make a significant dent in the inflation figure.
Mm-hmm.
So I've heard that it could drop as much as 2%, which would be pretty phenomenal.
Okay.
Once that kicks in, once that lag catches up
Okay.
and the true numbers of inflation come down, we believe we'll start seeing some noticeable changes in mortgage rates.
Interesting. So from yesterday to today, there was no change then in the mortgage rates or interest rate for mortgage, correct?
Actually, great question. Mortgage rates today are rallying.
Hmm.
So mortgage rates are up 46 basis points, which if we were to look at a rate, it's probably not quite an improvement of 1/8%, but it was very positive.
Hmm.
The other thing that kind of works similar, kind of competes with mortgages, is the 10-year treasury bill.
Yeah.
The 10-year treasury bill, when that's high, mortgage rates are high, that reacted negatively today, which is good for mortgage rates. So the 10-year treasury came down. That was positive for mortgage rates.
Hmm.
Mortgage rates rallied. The stock market didn't do so well today.
Yeah.
But one more little piece to this.
Mm-hmm.
Globally, the United States is so far ahead of many of our European nations. Now,
Mm-hmm.
our federal funds rate, and that's what banks charge each other. We're at 5%. I think the UK is at 3.5%. They've got a ways to go before they can really attack and get into their inflation. So I
Okay.
believe the United States is kind of leading the world in terms of pursuing inflation, but it's done a lot of damage. It's done a lot
Yeah.
of damage. I mean, we have suffered, no doubt.
Right. Right. Yeah. Gosh. And it's been so long since we've had inflationary increase. We to be at this rate, right? I mean, it was back in this early 80s.
Yeah.
I mean, that's when things we were not as well automated. We didn't have the statistics that we have today to be able to react to so many different indicators in our market. So it's like it feels like it's the first time we're probably all going through it in our professional life.
Well, a lot of these Fed chairmen have studied Paul Volcker, and he was the Fed chair way back when inflation was extremely high. It took him about a year and a half, but I think he more than doubled the Fed funds rate as to where we are now, and it took him about a year and a half. I think a lot of economists look back and use him as kind of the guru on the
Mm-hmm.
approach. The only concern that I've had with this current Fed membership is it's been such an aggressive, straight uphill raise in rates. It's my concern is since we have lagging indexes, they're raising it more than what they really have to because it's not really kicked in yet, and it's going to start kicking in and affecting inflation. I think most people's concern is that they overdo it. They bring
Yeah.
too much damage to the economy.
Right.
As you and I have spoken in the past, I think where we're lucky in the Twin Cities. I just read an article earlier today. We're probably one of the 6th best housing markets in the country. We have great employment. We have great schools. It's a good place to be. So I actually feel very bullish,
Yeah.
and I do believe rates are going to come down. But we've got a lot of turbulence right now.
Yeah. Yep. It'll be an interesting year, little ups and downs. And you hit it right on the head. I mean, it's a great place to live. It's a good place to be. We definitely had our home values increase, and we had a buzzer time during COVID, absolutely, but we didn't peak as much as some other parts of the country. And I think those leading headlines reflect real estate markets in different areas than we are here.
Yes.
So we are fortunate. Yes, we have had value increase, but we will not see the great decline like some pockets of the country are seeing. So in fact, coming off this weekend, I mean, we've seen some amazing reports. We are now officially, in the thick of our spring market. Snow on the ground, cold out, maybe a little bit, but that doesn't mean it's not spring.
Yeah.
So, right now we're at about 5,500 units on the market available for showings. This is true of most Februaries through COVID. Okay, so we have the same inventory feel that we've had for the last few years. Prior to COVID, we were at like 8,500 units this time of year. So, it's not just this year, all the years during COVID and now we've had low inventory. So, and buyer demand, of course, through COVID, and buyer demand exists today. We had a quiet fourth quarter as people tried to figure out what was going on. And now the reality is here and the rate environment is what it is. And people move a lot in the spring. We follow that calendar. And people are out in droves, and most listings are getting multiple offers again.
Yeah.
Yep. And if they're not selling in that first week or two, a simple price reduction will often do it. So, supply is low. Buyers are out working hard trying to get properties under contract, and we're seeing them start to sell over list price. We didn't see that for a while in fourth quarter, and now that's starting to creep back into our playbook. To get a home under contract, people are bidding. We're seeing right now an average of 101% of list price before an accepted contract. So, nothing like COVID, but it's starting to come back.
Well, I tell you what, Amy, this past weekend, I had a client put an offer in on a 265 single family house, East St. Paul, went in 40,000 over. Now, imagine if rates drop more. If rates drop to under 6, more people will come out, and it'll be very competitive. So borrowers have to be prepared and ready to act as quick as they can, and that's why I think this is a good time to be looking.
Yeah, it is a great time. It's going to be competitive again, but you have to have the right pieces in place, right? Pre-qualified, understand your top and your bottom, know where you can go, and know how you can react. Walking through that property with all eyes open, right? We are still seeing inspections in our offers. And we look at things that have sold in the beginning part of March. Our brokerage was trending about 30% of our transactions were waiving inspections. We're going to get a little bit back to that play. Yep. But they still do exist. So whether if you put one in an offer or not, you're going to want to still go in there eyes wide open, because there's not a whole lot of time to do those inspections if you do get one, right? So
yes, absolutely.
Yep. It's an interesting time. Well, okay. So it looks like really what the Fed's trying to do is not slow the real estate market down. The play is that trying to affect consumer purchasing. Stop buying junk.
And if we head into a recession, which there's possibility, real estate tends to do well. Mortgage rates tend to come down. So, you've got to feel confident in your employment. And that's why I like Minnesota, because we have such a strong employment base. But a lot of stuff going on. The Feds, I think the good news today was the Feds, instead of going into this very aggressive approach, now they're saying, let's just hold back here. Some people thought they would make a shift because of the banking crisis, but I think there is a possibility that there could be a pause. There was one more bump that was to be coming, and I think that might have been in June, but we'll have to wait and see what happens with the economy. They may hold off on that, and that could be favorable.
I mean, is that the next time the Fed meets? Is in June? I see. Yeah. Well, feels like a million years from now, right?
Yeah.
Gosh. Oh my goodness. Wow. Well, hey, Brian, thanks so much for an update about what all shook down at the Fed. For those of you that are listening, gosh, thank you so much. Brian, I appreciate you taking some time out of your day to learn about what's going on in the market, going out and having education before you put feet on the ground, and looking at properties and getting out there and writing offers. Brian and I have worked together for years. We have a great partnership, the kind of partnership that gives you an up edge when you are out offering on listings and you need to get a home under contract. So we'd love a chance to chat with you about your needs, if you're buying or if you're selling. Brian and I would love a chance to connect. Brian, thank you so much for your time tonight.
Thanks, Amy. Have a great evening.
See ya.
Okay. Bye now.